I'm going to ask everyone to use a brand new technology for most of us. It's called the iMind, and sort of imagine PowerPoint. I went to a presentation 4 years ago in which someone said, if you're over 50, you should never use PowerPoint. And so I went a year without using PowerPoint because I'm over 50. But as you mentioned before, it's the best tool for making sure you know where you are in your speech. And again, when you start getting old, you start to forget these things. Okay, so what I'm going to talk about today, and imagine a very humorous sort of cartoon version of Pope Francis. On Pope Francis, I'm calling it as 4 no's, and that is in Evangelii Gaudium, his apostolic exhortation. He has a section where he sort of gives his view of the state of the world economy. And his view is not different from Pope Benedict's view or Pope John Paul. It's consistent with the 2,000-year teaching in the Catholic social thought tradition, but he's emphasizing and framing a lot of issues differently. And he's framing it particularly, the beginning of that section, he starts off by saying, no to an economy of exclusion. And so I've been asked, since he became Pope, to give talks on Pope Francis and speaking with journalists, and they always ask, well, what is so revolutionary or unique about Pope Francis? And I think in terms of economics, that the way he frames everything in terms of the economy of exclusion. Now, the word exclusion has been growing in terms of poverty community for the past decade or so. And we've been using it at the Holy See Mission. One of the things that I do is I work on Holy See Mission interventions, which is the speech or statement that you'll give on a particular issue at the United Nations. Your country gives an intervention. And so it's not that this is brand new, but it's by emphasizing exclusion, he's emphasizing the importance of social participation for the human person. And if you know the tradition, John Paul's big contribution was adding sort of his philosophy of personalism to understanding economic issues. In fact, in many ways, it's sort of a little Marxian-type economics with personalism, which goes very much against Marxian-type economics, so it gets a new way of looking at the economy. Because in a Marxian approach, you assume that the human person is a social creature, which Catholic social thought emphasizes, but in Marx's famous sentence that a human person is the sum total of their social relations. You're understood sort of in a Greek sort of way as where you fit into the community. And your uniqueness and individuality gets lost. Whereas in personalism, that's something that's emphasized very strongly. So he finds a way, and I'm actually writing a little book on this, of bridging the gap between Adam Smith and Marx based on how you understand the human person, which just leads to different questions and perspectives. It doesn't lead to a different economic theory. I mean, it's not the role of Catholic social thought to come up with economic theory. That's the role for economists. But all economic theories are based on a philosophical foundation, and Catholic social thought challenges the narrow perspective either of neoclassical economics, which has the rational economic man model, or the overly organic approach that you find particularly in sort of the post-Marx Marxists, which is a mouthful to say, but in terms of the economic theories. And that's what I find interesting, because I find that many of the problems of economists can be traced back to how they understand the human person. So the economy of exclusion builds on the importance of participation, and participation not just in terms of economic participation, but as social, political, cultural, and spiritual participation, that we only become human through interactions with others. We grow as people through interactions with others. As John Paul says, we only achieve happiness by giving ourselves in love to others. And even our salvation requires the community. So that this is an old perspective for the church, but it leads to a very different sort of approach to social analysis. You just ask different questions. Or more importantly, you don't accept narrow answers. Whereas if you follow methodological individualism, everything has to be brought down to individual choice and nothing else. And if you follow methodological holism, everything structures. And we just need the right structures or the right policies or the right institutions, and you start to lose individual agency. And that's a very long, see, if you had PowerPoint, that keeps you from doing that because, well, that's not on any of the charts. But in the exhortation, by saying, say no to economy of exclusion, besides bringing up and framing everything in terms of exclusion, Pope Francis is also pointing out that the economy is a discretionary institution. That is, it's not say no to the snowstorm that's coming, because we can't do anything about the snowstorm that's coming. That's an act of nature. The economy is not an act of nature. The economy is a human institution. It's made up of humans. It has been different in the past. It will be different in the future. And not completely, but it is largely shaped by discretionary acts of either individuals or more likely institutions who have the power to shape things. And today, in terms of talking about financial systems, that would be the role that the financial services industry played in shaping public policy in the late 90s, 2000s, that dramatically changed so the rules of how financial firms behave, and leading to the financial crisis, which so many people enjoyed so greatly a few years ago. Right before the financial crisis, the IMF was threatening Canada to sue them because they hadn't liberalized their banking industry. And Canada refused to do it, and then of course everything blew up. All the advice the IMF gave everyone turned out to be bad advice, and Canada is one of the, I don't know if it's the only country, but it's one of the few countries that's never had a banking crisis. They've never had a banking crisis because they make sure their banks are nice and boring, and they don't allow them to engage in risky behavior with other people's money. Excuse me. Okay, so in the economy of exclusion, we have both a theory based on an anthropology, a view of the human person, on the importance of participation. And participation is, exclusion is there's two types of exclusion. There's one obvious exclusion, and that is where we block people from participating. And I'll use an extreme example. Under slavery, we are blocking the human agency of the slave. So I'm blocking them from participating in the social life of the community they're living in, not only in contributing, but also benefiting. So the both ways. But we don't have to go to the extreme. We see this in terms of all sorts of isms, racism, sexism. These are barriers to people participating in the social life. So it's not just in the economy. But of course, in terms of economics, we know a lot about barriers, entry barriers, and the role that they play, particularly in the modern economy, intellectual property and the way that it excludes potential competitors. Steve Jobs drew a little box, and that box is worth $300 million, or at least I think that was the fine that Samsung had to pay because they made a product that looked too much like that box. That sort of intellectual property rights excludes others from doing similar things. And so I would argue that no institution, no company, no individual gets really rich, joining the 1% or the 0.1%, where the real money is, unless they have significant barriers to others doing what they're doing. The whole success of a market economy in Adam Smith was in imitation. That if you built the better mousetrap, you got rich, but then your rate of return went down to the average as everyone else learned what you're doing and did the exact same thing. So if you have competitive markets, you don't have high profit rates for a long time. Large accumulations of wealth will not accumulate. They'll be short-term based on being the first one there. But there's also another form of exclusion, and that is not building pathways to help people to participate. Everyone who participates had a pathway built for them. None of us are born with abilities that we can just jump into society and participate. No, we all have formed and are helped along today with helicopter parents pushing, making sure nothing happens to us. But we're all brought along, and then others aren't. And we have an obligation, certainly Christians have an obligation, to work to bring people along, invite everyone to the table, the phrase that Benedict used quite often in his speeches. Okay, so but the economy of exclusion is not just a new sort of method or underlying theory on how to understand economic outcomes. It's also a critique, because then Pope Francis goes over example of where we can see exclusion in action. And again, he's gone to the areas where the North Africans are trying to escape the horrible wars and conditions in North Africa to get into Europe, and dying on the boats collapsing and all. These are all aspects of the effects of exclusionary systems. I would have argued that all poverty is based on exclusion. And it causes exclusion causes poverty, and poverty also causes exclusion. It makes it harder to participate.
Yes.
Oh.
Sorry to interrupt. Which file? I'll get it open for you.
It will either be the first one, that one, Villanova speech. Okay, thank you very much.
Is there any sound?
No, there's no sound. Oh, yeah, I didn't change that. Which is the feast day of St. John Chrysostom. But I started out with 35 slides. I'm down to 14, and one of the slides that lost was my quote from St. John Chrysostom. Okay, so there's the fun cartoon version of Pope Francis. And the 4 no's. No to an economy of exclusion. No to the new idolatry of money. And of course, this is not a new thing for leaders in the church, people of faith to complain about. I mean, but what Francis argues in that section, that it's not just that greed has a powerful effect on people, but that it's legitimated, that it's seen as a just pursuit in and of itself, and that so much of our society is reoriented towards that as the measure of the worth of activities and of people. No to a financial system that rules rather than serves. This is a very poetic way of explaining Hyman Minsky's money manager capitalism, although I don't know if Pope Francis has read Minsky. And then the other major theme in his recent, now since he's been in his pontificate, is attacking inequality. And so I'm going to look at each of these. I've already looked at the first one, particularly on what is the economic rationale and argument behind it. Pope Francis has been criticized, and one of the common criticisms that he has received, particularly from conservative American Catholics, is that he doesn't understand capitalism, or that he doesn't understand the uniquely virtuous version of capitalism in the United States. This was said by a very high official in the church in the New York area, which I found to be, a little hilarious, because the financial crisis was born from unethical behavior in his diocese. I mean, it's in New York where is the center of that explosion in greed and illegal activity, fraudulent activity. Okay, so what I think the economy exclusion does in terms of understanding wealth and finance is that it helps us to make the distinction, which other people have made, between wealth capture and, I'm calling it real wealth creation, because we'll see at the end that I'm offering a broader definition of wealth. But usually when we talk about exclusion, it's towards the poor. And social exclusion is sort of the big area at the UN on the committees that deal with global poverty. But that's only half. That's one side of the coin. You know, the people who are being excluded, the exclusion is not neutral to those who are doing the exclusion. They're doing it because they benefit from it. You know, when companies go into Africa and extract natural resources without paying anywhere near the worth to the countries or leaving all the environmental damage, the cost of the activity on the people, they're doing it because they're making lots more money doing that. So their wealth is enhanced by the same process that has increased the poverty of those who are being excluded. And I would argue, and there's some good evidence, that much of the increase in inequality in the United States can be traced back to this type of exclusionary behavior, which did two things. It kept wages from going up and stagnant incomes in the middle and bottom, and channeled all the surplus in the economy to the top 1%, top 0.1%. James Galbraith, the son of John Kenneth Galbraith, his book on inequality, his empirical results show that if you take out 6 or 7 counties in America where CEOs and Wall Street executives and traders live, inequality in America has only gone up a little in the past 30 years. It's all gone to those 6 to 8 counties, 4 or 5 around New York City, including Manhattan, a couple around Washington, lobbyists, and Silicon Valley area. And that's basically where, if you did a geography of where the money went, you would get a map showing you that. And it's by changing the rules to benefit that very small minority. I think he had it down to like 34,000 households, or I forgot what the number is, but that changing the rules to benefit them, which at the same time hurts everyone else. So wealth capture is when you increase your wealth without increasing the size of the economic pie, as we like to say in economics. It's sort of like if I go and play poker, at the end of the night, the same amount of money is there, just different people have the money. Whereas real wealth creation, typically we say wealth creation is when the size of the economic pie is bigger. But the Catholic tradition is arguing also for a broader understanding of wealth or of capital. And so it's not just that the economy grew, but that well-being improved somehow. Okay, and just here's some evidence that would suggest that a great deal of wealth capture has been going on. On your left, this is the distribution of gains from different booms in the economy, growth periods in the economy. The blue is the bottom 90%, the red is the top 1%. And so you can see the 90% was growing faster up until the 70s, and then declined significantly, and in the latest, since the crash, actually has gone down negative. And on the right, we have a table that looks at world gross national income per capita, and we see from 97 to 2007, sort of the boom, the big years of the Clinton years through up until the financial bubble, that the average world income grew 49.1%, so that's a broad measure of economic output for the country, for the world as a whole. Yet the high net worth from the World Wealth Reports, high net wealth individuals, wealth theirs grew at 113%. So more than double the rate of the overall economy. And this is one of the arguments that Piketty has been making in his book on capital, is that if the rate of return on capital is faster than the growth rate of the economy, that this will cause various problems. I mean, that's sort of a simple way of summing up his fundamental equation in his analysis. Now, I've had problems with the analysis because he assumes you can measure capital easily, and no one's come up with anywhere near a good way of doing that. So, but the basic principle, I think, is right, and that is the industries like finance, they live off of the surplus created by increase in output in the real economy. And they earn that by helping to direct the flows of capital to where they can be used productively in the real economy. And so But their share is like trucking. It's how well they service real activity. But we have seen that their share has gone up considerably without the corresponding dramatically increases in productivity overall. Their share has increased, others have gone down, particularly wages have gone down. Okay, if we look at the history of wealth, we would see that the history of wealth is the history of force and fraud. You'd have a hard time finding a time period where one group got very rich without it being at the expense of someone else. And we were talking about going to Rome. With, a lot of professors go to Rome. St. John's runs programs in Rome. And we go there and we look at all these great things that were built by an empire that exploited everyone around the Mediterranean. And the exchange was, you send us useful things, and we get to keep all the slaves we capture, and we give you protection service. So it's a standard protection racket that anyone who grew up in Brooklyn or the Bronx would know very well. And this is, all empires grew that way. All colonial empires grew that way, even though they did develop new technologies. Certainly the ancient ones did, but they didn't use them towards increasing material output. They used them for warfare or for helping to make cities, aquifers, indoor plumbing, some of the great things that the Romans figured out. But for the most part, technology was driven by how can you better kill the people that you want to kill so that you can capture enough slaves to support your slave economy. 50% of the Roman Empire would have been slaves. All those ancient wars were slave shopping expeditions. That's why they were fighting each other. So they had a supply of slaves to do all the work. So it's clearly the wealth of the great empires is a transfer from the hard work of individuals to the relatively few who get the benefits from that. And the slave trade and the growth in America, the New World, created such wealth that funded the Industrial Revolution. In fact, Keynes argued that the English economic exports was all funded by Sir Walter Raleigh stealing gold from the Spanish, who had stolen it from the Peruvians. That the wealth of England's export earnings all were funded with that, and if you just paid that based on a regular return in a bank, it was the same amount of money. And that's also true for most empires, in fact, probably all empires. They get a huge influx of resources from outside, and that's how they make the leap to being above everyone else. But that's another issue. Now, Adam Smith argued for a different idea of wealth, that wealth should be created through mutually beneficial trade. You know, Adam Smith was against mercantilist policies, that's colonialism, because he felt that this is what I would call wealth capture. This is benefiting one group at another's expense, and that we should have beneficial exchanges and economic growth based on technological progress. The division of labor makes us more productive. Expanding the size of the market allows us to exploit the division of labor. This is Adam Smith's growth model. And it's revolutionary because it's based on actually improving the standard of living of the average person. Adam Smith said that the needs or the wants of the master class, the businessmen, should only be attended to if it's to the benefit of consumers. So that is the bottom line, the average consumer, not what is best for any of the elites. Okay, and finance is a particularly exclusionary institution if we look at its history. Because historically, if you were lending, that meant that you had accumulated wealth, almost always through force and fraud. Now, usually, if you were a gentleman, you inherited it. There's a great passage in St. John Chrysostom where someone tells him, I didn't steal this money, I inherited it. And so he says, that just means your grandfather stole it. So if you have surplus to lend, and if you're making a business out of it, it's because you've been, or your ancestors have been successful in accumulating resources that would have gone to everyone, but now you accumulate into a small amount. And lending money was a particularly successful way in controlling those under you. And this is why all the major religions and particularly the church, was so strong against usury, because usury, who was borrowing money in the Middle Ages? It was someone who was in desperate need who didn't have the resources. It wasn't until after maybe the 1100s that you start to get borrowing for a business purpose. And by the time we get to the scholastics, they have all these exceptions to usury because you're not lending the money, you're becoming a partner with them. So you taking some of the risk, you deserve part of the return. In fact, John Maynard Keynes, in his general theory, defends the church's teaching on usury. And he says that he was taught to believe it was just Jesuitical nonsense, but he now comes to believe that the scholastics understood the difference between the marginal efficiency of capital and the scarcity value of money. And exploiting the scarcity value of money is just using economic power to exploit others, whereas the marginal efficiency of capital is using the borrowed money is being used for something productive that the economy grows as a whole. And of course, we have many examples. Redlining was a practice where banks actually drew a red line around neighbors. We will not lend to them because they're poor, because they're black, or for whatever reasons. Payday loans is a major area. People doing research now. The poor are often paying 200–300% on borrowed money if you look at it at an annual rate. Subprime loans, the whole use of subprime loans gearing minorities towards them who who qualified for regular loans was clearly used as a way to transfer the wealth of the poorest and minorities away from them to the people who now own all the homes, which are investors who have been buying up real estate since the crash. Dead peasant policies, if you've seen Michael Moore's movie Capitalism, companies who take out life insurance policies on their employees for them, and not executives, but Walmart. They have an example of Walmart taking out on a checkout counter, someone who worked in the cash register. And she died, and Walmart collected $90,000, and the family thought it was for them, and they were, well, why weren't we getting it? Well, Walmart took it out for them. That a lot of large companies have, they call dead peasant portfolio, that it's an investment. And it's an investment where it only gets a positive rate of return if your employees die at a faster rate than the actuarials will predict. Because if they live longer, you'll have lost money on that investment. You would have made better putting it in the bank. But if they die earlier, then you earn profits. And he shows memos where companies are complaining about underperformance of this portfolio, which means our employees aren't dying fast enough. Now you understand why these companies don't want to give anyone insurance, because they have a monetary interest in them dying quicker. And of course, Goldman Sachs selling the bundles of assets which they knew, which were designed to crash. Some of these, 50% of the mortgages didn't make their first payment. So these are clearly fraudulent devices. Sold them to pensions, mostly union pensions, small governments, and then took out insurance, that is, placed a bet with AIG that these were going to go under. And AIG, being run by the 6 stupidest people in America, who actually were in England, but took all these bets, and to the tune that the US government had to pay off all these bets. Much of the $186 billion bailout of AIG was paying off these bets. And most of these bets were insider. They knew, the people who took the bets knew that the housing market was going to crash, knew these neighborhoods could not afford these homes. They had seen the raw data. Standard & Poor's wasn't allowed to look at the raw data. It was clearly an act of fraud and illegal. Okay. But what the church is arguing, the Catholic tradition, and this is a model, the integral human development model the Catholic Relief Services uses. They're coming up with a new graphic. I haven't seen the new one, but I like this one. But it shows how everything's sort of interconnected in terms of the economy and society, but also on how our assets aren't just the physical, natural, and financial assets that we trade on at markets, what the price of oil is, money market, the ownership of companies that own factories, but that also political, social, and spiritual human assets are very important. In fact, human capital is the biggest determinant of standard of living of a country than anything else. World Bank has been publishing a lot of research on that. And all these take resources. You have to invest in communities. You have to invest in democracy. You have to invest in people. And when you design communities, designing communities that have a sense of community is very important. And they just don't organically just grow up. But we can't do these in a sense where there's a market measure and where the market will allocate these things efficiently. There's no way you can come up with a good market for humans on who should you invest in, who you shouldn't invest in. That we would not consider an offense to humanity to run, and which, your college education would be based on people buying options on your future income, and you get two finance professors, they can work out all the details fairly quickly, but we wouldn't, that's a futuristic movie that we would consider like a horror show like Hunger Games. This is not a type of society we want to live in. So capital, our assets can't be only reduced to what can be traded in markets, and we can't assume that markets always allocate these things efficiently. And I think there's a lot of evidence, this is based on some of the work of Randy Wray, an economist that is a friend of mine, but I've been following his work, has been arguing for almost 10 years now that there's just too much wealth in the world. There's too much financial wealth. And of course, all financial wealth is matched by debt, assets, liabilities. In fact, if I have an extra $1 billion, it's really not an extra $1 billion of wealth unless someone's borrowing that $1 billion in some form. If it's just sitting there, then I just got a lot of green pieces of paper. So it's really, wealth is an asset that has a yield of some sort. And so if you have people growing super rich, you have to have someone else going into debt. And that debt has to be either household debt, company debt, or government debt. When the US economy had a surplus in 2001, 2002, Randy Wray's models, the Levy model, predicted 2007 the US government would have a deficit of 9% of GDP. And I taught this to my students. How is that possible? I couldn't figure out how it's possible until I came to understand their model. It was inevitable because if the US government's running surpluses, they are sucking the wealth out of households and businesses. And the economy couldn't handle that. People want to save. Businesses want to accumulate wealth. They can only do that if there is a negative somewhere. You could do that if you have a huge trade surplus like China, but we don't have that. So it necessarily, the accounting works out, it has to come from the government going into deficit. In fact, Jamie Galbraith gave a speech in 2002. There was a big conference of economists on the surplus, and he was the only one who spoke that this is a major problem that's going to cause us, this will not last. We're not paying off the whole debt in 5 years, as everyone was saying. This is going to crash. And he was literally laughed at. And of course, he was 100% right. Okay, so we need a financial sector. Basically what a financial sector system does, it handles lending. We have people who have surplus money and people who want to use that for somehow. We need processes that allocates that. And having a market mechanism is helpful there because at least you have a benchmark that's not just being allocated as it happens in many developing countries to who's related to someone with political power, but it's you have a better plan than they do, and that's why we're lending to you because we think that your company will be more successful than another company. Now, throughout history, there was a scarcity of lendable capital up until we went to a fully fiat currency, and now there is no scarcity. No major bank doesn't make loans because they don't have the money. There's no, I'm sorry, I'm all out of money. No, a little phone call to the Federal Reserve, the money's there. Or just go to the capital markets and borrow it. In fact, banks typically find the lender and then find the money after it, not, oh, I got all this money, now I have to find people to borrow it. But community banks operate like that. They don't have a window, the discount window. So we need to rethink how the market discipline has to work with that. If there's a real scarcity, market discipline, I think, can be very effective. If there isn't, then I think you have a new set of problems, and the too big to fail institutions are a result of not having that discipline of, I only have a certain amount of money, that's my deposits, which I can invest. You also have to operate a payment system and increasingly risk trading. And that's where all the derivatives and all the complications came. The derivative market, the financial crisis hearings at the UN, I was shocked when they announced that at that time there were 600 trillion with a T derivative contracts out there. The world economy is like 80 to 100 trillion. There's $600 trillion of bets. And there's an unlimited amount of bets because you don't have to have any collateral for any of this. You know, you could bet on every football game with every friend of yours. There's no, as long as people accept both sides, it can go on until a small number of people stop paying, Lehman Brothers, and then the whole system seizes because it's so intertwined. We can't assume, I don't think, that financial markets, the Fisher market hypothesis, actually works here because there's no transparency. The level of asymmetric information is complete. There's almost complete ignorance on one side, and there's the people who structure the things to be so complex that only they understand it. Clearly that needed to be regulated more. But finance is a service. It serves the real economy. I don't know what happened there. Okay. And I lost the cursor. Is our expert here? See, I mentioned Goldman Sachs, and I used to was paranoid that Bill Gates was after me, because every time I said something about that, my computer would crash. No, I can't get the cursor to move. Oh. Okay, it's right there. Just hit that. See what happens. Okay. Okay, and so, but one of the ways that we see this transfer of wealth from the real economy to the financial sector is in the major explosion in activity and function in healthcare and housing that Wall Street has undertaken. There's no reason for Wall Street to be involved in healthcare at all. It's fairly easy to figure out what the healthcare costs for a country are. You budget that, and then you take care of the sick people. The Canadians manage to do it. The rest of the world does it for half the price that we do it. And that extra 50% that we pay is, a good part of that is money going through Wall Street. So every time everything has to go, and insurance is part of finance. It's finance, insurance, and real estate. Every time money goes through that, they're taking a chunk of it. And also the housing. There was no reason for securitization at all in our housing market. In 1973, we financed and built more new homes than we did at the peak of the housing bubble, with 1/3 less population. And that was done the old-fashioned way, where banks made 30-year mortgages based on the money that they had. Wall Street wasn't in the loop at all. But once Wall Street came in the loop, and particularly once they turned it into assets that they securitize and gamble on, then you created a bubble. The same thing with food. The food was outside of Wall Street for the most part. You had futures that were only companies that were in the food business were doing. But in 2002, the Wall Street companies were told, and also for their own interest, they wanted to move away from treasuries as sort of the basic safe asset you never have to worry about, because Alan Greenspan determined we need near zero interest rates so that we don't have a negative effect from 9/11 in the economy. They kept interest rates very low. And so they went into mortgages, which were considered risk-free, but also they started speculating in food. And so now the volume of trading on food futures far exceeds the real demand for food in these markets, and creates bubbles and crashes, which create riots and horrible conditions in poor countries that are much more sensitive to these things than we are. Okay. I forgot the guy, Taibbi wrote about Goldman Sachs that they were a vampire squid with their tentacles at every part of the economy where there's a possible income stream that they could tap into. And that has happened. So much of our economy is run not only through Wall Street, but by the logic of Wall Street. You know, we used to have newspaper companies that ran newspapers because that was the mission of the company, to run newspapers because they thought that was valuable. Now they're just another company, part of a portfolio that have to perform at the same rate as other businesses. Newspapers earned 2 to 3% from 50 until 1980 before this started to happen, and it had no effect on the number of newspapers. People were newspapermen. That's what they did. As long as they were paying the bills, staying afloat, they were happy. Now they have to compete with Apple and every business once they become part of this whole what Keynes called casino capitalism. So you have a transfer from the real economy to the financial sector, which causes an increase in debt. Since wages didn't go up, household debt exploded. So as the middle class could maintain their middle class standard of living. The decline in the share of wages, we see that as a long trend down. And this, of course, creates instability because speculation is such a big part of this. And for Francis, what he's trying to emphasize is that this leads to rising inequality, keeping one part down, and all the benefits are going to a small minority. And in the famous tweet heard around the world, inequality is the root of social evil. And there's a lot of evidence. I don't know if you've heard of the book, The Spirit Level, but they have a series of graphs that look at the relationship between different social problems and inequality both in countries and in states. And so every problem they look at both internationally, and then they look at all 50 states, and you see the same relationship over and over. They also combine it all together, and here we have an index of life expectancy, math skills, infant mortality, homicides, teenage births, obesity, mental illness, and social mobility. All of these go the opposite way that you want them to go if you have a highly unequal society, and they're lower if you have a more equal society. And if you change the states, you have the same graph. The graph is more dispersed because we have states like New York, probably the most high inequality, or among them, because that's where so much of the wealth is. But we're a high tax state that spends a lot to try to compensate for that, whereas you get places like Louisiana or Alabama, high inequality and no revenues, state revenues to go to combat that, because that's money that might go to black people. And if you look at the history of taxation in the South, it is designed to make sure that no money is there in the government to help poor people, which is to help the descendants of the slaves. And this was created during Reconstruction as a specific policy goal. I've been reading this book about it.
The Gini index?
Yeah, I think so. I'd have to look, because they use different ones. But yeah, that would be the Gini index of some sort. And the World Bank have been writing about this for a long time, looking at inequality and homicide rates. And
what's the connection?
well, there's a lot of different connections, but one of the connections, and the guy who wrote the book, The Spirit Level, I think his last name was Wilkinson. I read his earlier book on inequality in health, and he is a public health professor. And in the 80s, he did research, and it's comparable to the effects of racism on health, that there are physiological effects, that the stress level for being poor and struggling releases all sorts of chemicals, just like most of the diseases we get often are connected with stress. There's lots of books, Stress That Kills You. And that the stress of always being short and worrying about feeding your family and your next paycheck and all the things that go with the daily grind of being poor, that these lead to physiological effects. And a lot of public health doctors have seen that the same thing happens with, in terms of like racism, just that has this cumulative effect that physiologically they're increasingly able to measure. And it's not just a social factor, that it actually affects cell structure. With inequality and homicide, a lot of homicide and crime is seen as the inability to achieve what you want through normal means, which is earning a job and a paycheck, et cetera. And there's a lot of good research in why crime rates have gone down in the United States so dramatically, and most of the effect is because of the Clean Air Act and the taking of lead out of the environment. Because lead in the environment is the major cause of mental retardation, which is diminished IQ. And IQ scores have gone up significantly in areas which used to have very low ones because the lead rate exposure has gone down considerably. So if you raise the average IQ of a population to 10 points, you're dramatically reducing the crime rate. Because if my IQ is such that I can't understand why I'm not able to get what I want, well, then I'm going to take it and be violent. Whereas if I can calculate and think through, oh, well, here's a successful strategy. I could work here and I could go to school and do various things, then you're less likely to go into a life of crime. So we've had two effects. I mean, we should have an increase in poverty of crime because of increase in inequality, but we've had this other change in the environment that has had such a dramatic effect in lowering the number of people with low IQs because we've taken lead out of the environment. It could be the best piece of legislation the United States ever paid in terms of the health of people, is just taking lead out. Okay. So what is the church to do about this? Well, Pope Francis and the Catholic social thought tradition, as I mentioned before, it's not an economic theory, and it's certainly not an economic system. You know, one of the things, I hear two complaints working with Catholic activists over the past 20 years or so. One is the church should stop telling us what to do all the time. The second is, why doesn't the church tell us what to do on these problems? And you know, I've heard many people say the exact same thing in the same half hour, because it's up to each society to figure out how can we bring people out of poverty, and how can we raise development levels, and how can we protect the environment so that we have a sustainable future. This isn't something that theologians and pastors should be solving. Their job is to give a prophetic witness to when it's not happening, but not to come up with, well, this is the Catholic tax rate, which will lead to optimal participation. No, that's each society's responsibility. But what the church does do, I think, is emphasize the people-centered ethics, the phrase that Benedict used many times, and that is just a system of ethics based on a full understanding of the human person, that each person has human dignity, they have a necessity of social participation, they have rights and responsibilities, they're moral beings. That is, that we're both individuals and we're members of a community. We're not either or. I mean, if you go to a conference on Catholic social thought, almost everyone says the Catholic tradition is never either or, it's always both and. And so this is, this view of ethics, person-centered ethics, is an attempt to bridge, I think, because a lot of my work as a historian of economics is looking at the two different views of the human person, how they don't speak to each other. This is one that goes in the middle, that takes aspects from both, and hopefully help them to communicate. But also to revive the teaching on usury, on that wealth gained, this is the Lateran Council, gained from the use of a thing not fruitful in itself without labor, expense, or risk on the part of the lender. In fact, Thomas Aquinas said that usury was wrong because it leads to inequality, because he saw that the borrowing relationships in the 13th century typically were that. The other major borrowing would be the king to fight wars or to marry a child off or something. You don't have to worry about them. They have their own power. But people who are powerless, you have to worry about them. And we also, I think, need economists to understand that money is not gold. It's not a commodity. Its physicalness is meaningless. Its quantity is meaningless. We've had people worried about quantitative easing and the Federal Reserve is printing money. Of course, they don't print money. They keystroke. And within a 3 or 4 week period, or maybe 3-month period, Ben Bernanke lent out $27.5 trillion with a T. Just, you know, I've been to conferences where people have brought up, well, China can crash the dollar because they can cash in. What happens if they want to cash in their $2 trillion in government bonds? I said, it'd be no problem at all. Janet Yellen just say, hold on. I assume she has to go to a computer and not to her BlackBerry. I'll just put that into your account. And out of thin air, $2 trillion will be in the account at the Federal Reserve for the Bank of China, whoever handles their things. And then they'll have $2 trillion and they'll figure, what do we do? Well, we either buy $2 trillion worth of American things, which means we'll be in full employment the next day, or they'll say, well, what are we going to do with $2 trillion? Well, maybe we should buy government bonds so that they'll be safe and at least we'll get a rate of return. But there are only two options. So money is just different now. It's very different. In fact, the story of how money came about is that Adam Smith thought is wrong, and we should maybe come up with a new story. What is essential about money, it's about trust. It's IOUs. And what holds a monetary system together is trust as well as force. That is, what gives our value money, what gives the dollar money is that the US government taxes in it. So at least part of our wealth has to be in dollars that we send to them, that we return the government's money back to the government. Most monetary systems have worked that way, that they are based on taxes. And the taxes are there to create the value of it. But also the law, lender of legal tender and things like that. But money is just different. And to worry about what we worry about so much in terms of money supply and inflation causes a lot of bad policy. But it also, I think, in terms of finance, making finance more inclusive, well, first, put people in jail who broke the law and caused a lot of suffering. There's a guy, Bill Black, who was the prosecutor who led the savings and loan investigations, prosecutions. He put 1,000 people, he had 1,000 convictions. I don't know how many went to jail, but he had 1,000 convictions. And he's been going around since the financial crisis saying, you should have 70,000, because this is 70 times as big. And when the Justice Department said, well, we couldn't find anyone that we could jail, he pointed out, because he knows all the people involved, they only assigned 50 FBI agents to it. The biggest financial crime in the history of mankind. He had 500 to 1,000 with them all the time working on the savings and loan crisis. Well, they didn't look. In fact, in a moment of honesty, which we almost never get from elected officials, the Attorney General said that we really can't jail any bankers because it might have a negative impact on the economy. Now we're getting fined after fine, but as a disincentive, there's nothing like 10 years in jail, even if it's in the Club Fed, to encourage people to be a little more honest in their dealings, because so much of it is based on fraud. And we should also stop subsidizing activities that are really wealth capture, such as the lower tax rates that hedge fund managers get, the way that Romney was able to pay 14%. The income he earns, and much of what he did is he'd buy companies, load them with debt, raid the pension fund, pay themselves huge fees for it, and then have the company have to pay that off. Well, that's a transfer from the company to themselves. Whether they got the company to work more efficiently or not is another issue, but generally hedge funds do this, and then they just pay lower taxes having done that. There's a big debate on the Tobin tax, that we should tax speculation. I was asked to write up something for the Holy See Mission on this. because every group that wants social change wants to fund it with a Tobin tax. So if you add them all up, it's 50 million times the GDP of the world. I mean, everyone. We can solve poverty with a Tobin tax. We can clean up the environment with a Tobin tax. A Tobin tax should be like a cigarette tax, that it should not be designed to raise money. It should be designed to discourage the activity, and the revenue should be completely irrelevant. We're having a little labor issue in the police department. I work with the police union, so I know a little bit about this in New York City. And for a couple weeks, the police weren't enforcing petty crimes that they usually do. And some people were complaining that the city wasn't collecting revenue. And Patty Lynch, the head of the union, testified and said, listen, the police are not here to make money. We're here to bring law and order. And if not giving out all these things, all these tickets were basically, and there were a lot of, this isn't so much in New York City, I expect, but I haven't looked at the books, but a lot of small towns, particularly in the West and the South, 20–30% of their government is funded by these petty tickets, which are mostly the poor people. I spent half a day at traffic court in Nassau County, and I sat around there saying, I am the only upper middle class person here. These are all poor people paying tickets because they drove by a school and a machine took a picture of it, and they're there paying $400 or $500 because they got 5 tickets before they realized that there was a camera there taking picture because they were going 30 miles an hour past a school, and this is over summer when the school wasn't even in session. Nickel and diming poor people as a way to fund your government is clearly redistribution away from the rich people who you don't want to tax and placing a burden on poor people. And also, like in the South, they tax, in Alabama, they tax food at grocery stores. 12% in Alabama you'll pay in some of the counties. Now, poor family, 12% is the difference between going 3 meals and 2 meals often. It's insane, but it's because they say we can't raise taxes on property owners. But again, that goes back to the setting up of the system after slavery. But the Tobin tax, if it's effective, it reduces speculation and should be revenue neutral. It should be balanced with an offset. It should not be a way to make money. Because if it's a way to make money, then you want people to speculate. And then, well, if you want people to speculate, then don't tax it. Sort of like in Moscow after the communism fell, alcoholism went through the roof, but the Russian government couldn't do anything about it because the only revenue they were collecting was from vodka sales, because no one else was paying taxes. That can't be a good long-term model for community development. Also, breaking up anything that's too big to fail is too big, I would argue. Change the incentives. A lot of people have written about this, and this is a big part of the UN report, particularly for hedge fund managers, the 2 and 20% rule, that it's just pushing people to be more speculative. Even if you just average compensation over a 3-year period is one of the reforms people suggested. So, I get 20% of the earnings of my clients over a 3-year period. Instead of one big year, I cash in and then they're paying the price when the bubble crashes. So the big thing that's going on in the development world in terms of community banks or some banking system. I had a student who did her master's thesis on the lack of transparent and honest banking in rural India. And one of the effects was debt suicides. You had a system designed to get people into debt as a way the landlord control you. At 30–35% interest, you're never getting under that. And in a culture in which you believe in reincarnation, suicide really isn't that bad an option. And so you have this high 15,000 farmers are killing themselves a year with their wife and children often going to the sex trafficking trade to pay off their the father's debt. Now, not only do all communities need banking services, and they need to be honest and transparent and not tools to exploit and control. And also, there are some industries that I would argue that we don't need the discipline of Wall Street's markets. Healthcare and education would be the first two. As I like to say, sick and stupid is not a good strategy for a country to pursue. It's what the World Bank and the IMF used to enforce on African countries in the 70s and 80s when they thought their debts were too high. Cut education, cut healthcare. Luckily, the World Bank has figured out this is a really bad policy. It led to disastrous results. In the past 10 years, they've incentivized them to expand healthcare and education because the future of a country is its people. But other countries have figured this out, and I think we should too. So you need financial services, you need a financial sector, and you need a financial sector that is market discipline. But you don't need it to be the final arbiter on everything else in your society. And we've developed that in the past, since mid-70s, 80s to the present. We had that in the 20s, and then the New Deal and the Great Depression took care of it. And World War II in two ways. The Great Depression allowed a lot of rich people to lose their money, and World War II forced us to tax rich people at a very high rate so that in the 40s and 50s we had a process of more equality. We reversed all that in the 70s, and we're back to where we were in 1929. You're going to have to reverse that. It'd be nice to do it without a Great Depression and a World War, but a democracy cannot really call itself a democracy if we persist in such an unequal society. Thank you very much.
We do have a little time for Q&A. Anyone?
Thank you very much for that talk. It was very fascinating and compelling. I just have a very basic question. You said that it's not the business of Catholic social teaching to engage in economic theory. But then you also said that one of the important realizations that has to happen is that money needs not to be looked upon as a commodity, but as an expression of trust.
Yeah.
How is that not
Well,
economic theory?
it is, and
One I happen to like, by the way.
yeah.
And I'm not
No. I have what the church can do, and then what economists need to do. So I would see that as separate. However, my field, I mean, as Barbara mentioned, I did my dissertation under Robert Halbriner. I went to the New School to study the history of economic thought under Robert Halbriner. I got into economics as a philosophy major, and I realized all the debates I was interested in were really economists and not philosophers. So I majored in philosophy. I didn't know I'd spend a career doing applied economics, but that's what I was interested in.
You sound like Karl Marx's history.
I didn't marry the daughter of the richest guy in town, which is a successful strategy that Marx pursued. Although he still ended up with boils, so maybe it didn't work so well for him. But economics is a branch of moral philosophy. That's where it came from. And up until, I'm sort of like the end of people who got a graduate degree in economics who studied the history of economic thought. It's no longer required in any major any major economics program, and not offered in most. I've gone through, particularly my students apply to graduate programs, I always look through, and I never find anyone who has a field in the history of thought or a history of thought graduate class that's being offered. So it's completely been marginalized. Yet, it was valuable for showing where did all these ideas come from, because they come from a philosophical foundation, perspective. A lot of it is based on utilitarianism, which is a philosophy. A lot of it comes from the Scottish natural law tradition, which actually that's what my dissertation was on. All the great economists, up until and including Keynes, were philosophers as well. And since Keynes, we have Sen. In terms of great economists who were fully literate as philosophers. And so not only is it, I think, dangerous not to understand that there's a philosophical foundation for what we're doing, and that it's not just models that we can just play with and not know what are the concepts underneath it. Also, if you have that sort of background, you see economics as a social science that should be in dialogue with the other social sciences. And that is even more rare than economists talking to philosophers, is economists talking to sociologists. Sociologists are there for a punchline for us. Yet, economic activity is always social. if we want to understand the most basic thing, like consumption, people shopping, what it means, then we're really not going to know much unless we read people like Mary Douglas on the world of goods and how all consumption is a social act and not just individuals maximizing with their preferences and their budget constraints. And so I think the narrowness, the divorce from philosophy is a divorce from the social sciences as a whole. And which is, I think, adds to or contributes to why only maybe 2 or 3 neoclassical economists, well, actually only one neoclassical economist saw the financial crisis before it happened. That's Schiller, who's predicted the last 3 crises. And why he isn't the richest person on the planet, I don't know, because he successfully predicted almost to the year for most of them. But I guess they don't pay you enough in Yale that he could gamble with the money, but he has to make a lot from the Schiller Index. But in any case, all the other economists who were complaining about this as a problem, from the Levy Institute from 2002 and Randy Ray, Dean Baker, and the others who in print before the crisis were saying this is not a stable system. My friend Randy Ray gave a talk to Federal Reserve staff April 2008 called The Financial Meltdown. And they said, oh no, there's none of these problems. And he almost went month by month what's going to happen. And he was only off by like a month on how these things were going to crash. And you could date it from when the subprime loans got the new level of craziness. So first it was, well, we didn't really check your income. Next, we sort of made up your income. Then there was the ninja loans, no income, no job, no assets, we'll give you a loan. These came in waves. They didn't start in insanity. They start with stretching it a little, then a little more, then no touch with reality. And each of these, 5 years later, were going to cause a major crisis. And there was one economist in Ireland who predicted it, and the prime minister tried to get him fired and called him an idiot on the television and ridiculed him because he just pointed out that housing prices in Dublin have no bearing with any sense of economic reality. And I think this lack of vision that comes from not being in touch with philosophy and sociology really gave them a narrow binders. They have these models. And interestingly, all the models they use 5 years of data. So they didn't even, if they had just gone back to the last time we had a crisis, the pricing of these assets would have changed dramatically, and you wouldn't have had a flood of people investing in them because there would have been the possibility that maybe these things could all go south quickly. That wasn't even considered. Someone went back with some of the models and put in 10 years of data, and then the pricing of these assets, once you have real risk, they're too expensive. You're not going to invest in them. And people weren't buying these things because they were stupid. They were buying them because they were only considering a narrow range of facts and not a broad range.
This might sound like a slightly naive question, but I mean the way you describe the inclusive society, it's almost like this ideal. How do you go about getting there with the way you're going to have Wall Street against you, you're going to have politics against you?
Oh, well, certainly you need a major political transformation in terms of the realignment of citizen rights. So, the Citizens United certainly is a huge barrier to overcome. Or just in half the country, making voting a huge hurdle to overcome is another thing. So, we have to probably work more on having a real democracy than anything else before you can have any real change. It almost would have been better if Bush had another 2 years and the things just got uglier and uglier. And then you could have had Roosevelt, who had 4 years of depression, to walk in and then say, we're going to do something different. He didn't have a clue as to what that was. He was probably one of the worst presidents we've had in terms of understanding economics. But he knew it didn't work, and he was willing to try anything. And so it would have been good if we had that. Then maybe we could have had another New Deal, New Deal Part 2 or whatever.
He also had Francis Perkins.
Well, yeah, he had a lot of good people around him, and what he would say, whenever groups came to him and said, you know, Mr. President, we need you to help us here. And he said, I need you to make sure I can help you there. You know, keep the heat on. And you had none of that. You know, Obama had this huge coalition of activists, and he should have said, okay, now for 4 years, be the biggest thorn in my butt. You know, you have to make the government do these things. And he had none of that. But in terms of Catholic social thought, it's not utopian. You know, one of our most basic doctrine is original sin. It is not utopian at all. I mean, we don't expect to have a perfect society. The goal is to have improvements, build towards the kingdom of God. Once someone says that they have the utopia, move. Because generally, if someone has utopia, unless their name is Todd Rundgren and he has a guitar, no one's old enough to remember him, but if they have a utopia, then the only way you can have a utopia is to make the perfect man, and that means you have to kill a lot of people in the process. You know, the Nazis had a utopian vision. Stalin had a utopia. Get out of town when someone has, you know, life isn't going to be perfect. It's a struggle, it's a cross, and it's supposed to be. It's part of the redemptive value of suffering, which is a hard concept to deal with quite often.
Sometimes overworked, but
Yeah.
Bobby, you have one last
Well, I was
question?
only comment your 5-year remark. I'm a little worried as a finance professor and someone focused on investments that we're in that 5-year analysis, we're losing 2008.
Oh.
You see, and that brought us to our senses
Uh-huh.
in a sense. But now, if you only go back 5 years, you're losing the impact of what happened in 2008.
Yeah, and if you look,
that may be leading to the next bubble.
yeah, if you look at 2009 as your starting point, this is the greatest society in the history of mankind. Everyone's going to be rich.